All right. Well, good morning, everyone. First of all, thank you for joining us for the first in the series of the Bulletin webinars, which will accompany our latest forecast bulletin report release. We already have well over 130 people online, and that number is rising quickly. So that's a great turnout. And first of all, thank you all for your support and interest, which I think goes some way to telling us where we are in the market today. As we close the books on 2025 and follow on from a couple of quite challenging years, what's become clear is that growth is not necessarily guaranteed. And the businesses that are going to thrive in the years to come are those that truly understand the markets and put in place active and targeted strategies. So by tuning in today, you may actually be one step ahead of your peers already. I'm Tolga Necker, and I head up consultancy at Barber ABI, and I'll be running today's session. Now, this is a 30-minute webinar, and it'll include a 5-minute presentation up front where I'll summarize some of the key facts from the forecast bulletin. We'll then move on to a panel discussion where I'm joined by Nick Snazzle, Sarah Dawson, and Ed Griffiths. At the end of that, we'll have a question and answer, and you should all see a box towards the bottom of your screens. Please submit any questions, and we'll try to get through as many as possible. We just have a hand. I'll open up. Kirsty? Is there a question, Kirsty? If not, we'll crack on. So we will be recording today's session, and we'll make that available to you all afterwards alongside the presentation slides. We'll also be seeking feedback on the session, so please keep your eyes open for that form. As I mentioned, this is the first in what we plan to build into a series of webinars, so your input into what works well and what could be improved is invaluable. The full forecast bulletin, from which much of today's insights are gleaned, is now live and available for purchase at £400. If you'd like to know more about it, speak to your main Barber ABI contact or reach out to me directly and we can discuss. So on to the important stuff, and I will start to share a presentation. Okay. Hopefully you can see a forecast bulletin summary, January 2026. Thanks for the thumbs up, Ed. Okay, so the forecast bulletin is our construction sector forecasting report, and we produce this twice a year. So we use public information like the ONS output data, new orders, which Barber ABI is the exclusive provider to the ONS, our own projects and framework database, as well as PESEL analysis to project forward sector level forecasts over the next 5 years. The full report is about 90 slides long and full of tables, charts, and commentary. So really, it's jam-packed full of insight. And if you'd like to purchase it after the webinar, there'll be a link to do so. But to summarize where we ended up 2025. Total output growth was just 1.3% for the year, driven by new work at 1.6%, with RMI lagging behind at just 0.6% up. Of course, behind this sits a whole host of sub-stories, sector level, region level, and by reason, some of which we'll touch on in this presentation, others we'll discuss in the panel that follows. But by way of a scene setter, 2025 was pretty flat and the poorest year from a growth perspective since COVID. Now, it also marks what we believe will be the industry's nadir as performance improves over the next couple of years, as I'm sure you'll all be pleased to hear. Now, I'll need to temper that optimism slightly by pointing out that although performance will improve over the coming years, it sits firmly within the low to mid single digit growth range across the 2020s, what we might describe as modest growth. We've seen more aggressive forecasts out there, but based on what we see in the market today, we don't think those are necessarily realistic. It is, however, worth flagging that the growth rates that we're presenting here from 2025 through to 2027 represent a bit of a downgrade on where we thought we'd be this time last year. And just a passing glance at the news tells us that the world is a particularly changeable place at the moment, and it provides a range of reasons why that outlook has changed. But what's worth keeping in mind is that these forecasts do change over time, and it's always worth keeping on top of forecasts as they change and evolve to incorporate the latest data. But to understand what's driven the slowdown in performance through 2025, we need to look at the sectors individually. And there's no better place really to start than residential, where 43% of all construction sector spend occurs. So when the residential sector sneezes, the rest of construction catches a cold. And over the last 3 years, it's certainly had a sniffle. So the residential sector lagged behind expectations in 2025. At the start of 2025, we thought we'd be looking at about 3% growth, but that did not materialize. In fact, both RMI and new build ended the year completely flat. And this is the third consecutive year of stagnation, with just 3% growth experienced since 2023, and all of that growth coming in 2024. In fact, when we look at new housing output spend, it's not expected to hit the 2022 levels until 2027. That's effectively 5 years of lost growth. Now, I won't go into the detail now as to all of the challenges of facing residential. I'll leave that to the panel to discuss in a bit more detail, but they affect both supply side and demand side. But what I will share is a slightly sobering chart. So this chart is mapping the number of residential planning applications that are submitted in a year and the number that are approved in a year from 2020 through to 2025. And the trend is pretty clear. So the volume and value of planning applications and approvals has been declining year after year since 2021. And it's not just low planning officers that are to blame. The pipeline of developments that we're putting through has shrunk too. So whilst there are initiatives in place that could stimulate the residential market, we don't currently see enough to suggest that we're on track to turn things around and deliver 300,000 new homes a year in the short term, and less so the total 1.5 new homes that were pledged by the end of this government cycle, 2029. Our estimations are that we'll look at just 2% growth in the coming year, which will rise gradually to mid-single digits across the remainder of the 2020s. But there are some reasons to be cheerful. Sectors like industrial, health, and education continue to have a strong pipeline. Health and education are backed by large-scale government programs, which provide confidence ongoing in the opportunities that they present. Meanwhile, the industrial sector growth continues, I should say, but with a shift in occupier needs-driven development, moving from e-commerce-led warehousing and distribution, which boomed following COVID, towards more advanced manufacturing, such as EV battery gigafactories and data centers. Now, it's infrastructure that stands out as the highest performing category and driven by electricity and water and sewage. Electricity grew by 18% last year, and that growth is linked to the UK's ambition to become a global, a clean energy superpower, I should say. This is a policy that prioritizes the reliance on domestic production of renewable and clean energy and acknowledges the requirement to strengthen and expand our electricity grid. So there are high volumes of high value projects which are backed by government's pledge to double onshore wind capacity, triple solar panel capacity, and quadruple offshore wind capacity by the end of the decade. At the same time, water and sewage is performing really strongly as well at 15% growth. And it's worth pointing out that midway through 2025, we moved into the AMP8 regulatory cycle. This is a 5-year period that will see £100 billion worth of investment flow into our water infrastructure. So we expect to see continued high levels of growth through the coming years, particularly at the start of that 5-year cycle as investment ramps up before maintaining high levels. So that's where I'll leave the presentation for today, and I'll move over and defer to the panel to expand on their own experiences in the market and their outlook for the future. Give me 1 second. Great. So onto the panel. And they say that if you know more than everybody in the room, then you're probably in the wrong room, which by that measure means that I'm almost certainly in the right room today. I'm joined by a brilliant panel who bring a wealth of experience and expectation along with them. Now, I should point out that there's been a slight change to the original lineup. Andy Geldard was unfortunately unable to join us today. However, our very own Ed Griffiths has answered the call and stepped in at relatively short notice. And he joins Sarah Dawson, Head of Market Insights at Marshalls, and Nick Snazzle, Market Insight and Strategy Director at Stark. So, good morning to the three of you. To kick us off, could you each tell us a little bit about your organization and your role? And then just one sentence that succinctly summarizes your experience of 2025, preferably from a professional point of view, and then one word to encapsulate your outlook for 2026. Who wants to kick us off? Sarah, should we start with you?
Yeah, I'm Sarah Dawson. I'm head of market insights at Marshalls. I've been with the company probably about 25 years, and I've worked in market intelligence for about 15, 16 years now. So I've got a lot of experience of dealing with data and analysis. For 2025, I think one of the best ways of describing it is bumbling along the bottom. I think you're correct in saying it's been a nadir year. There are some structural changes happening within the general market. As you've suggested, a lot of growth appears to be coming through in infrastructure. Um, it is tentative how we see that growth coming through. Whether that pans out towards the end of next year or starts feeding through into the following years is difficult to estimate at the moment. We have noticed a lot of lags increasing between when contracts are awarded and when projects are actually starting. So that does feed through into the forecast for the next few years. So I think 2026 is cautiously optimistic in the second half. I don't see any real changes happening before then at the moment. But as I've said, structural changes happening within the market.
Thank you, Sarah. And I think we'll forgive you 5 words for 2026 instead of one. Nick, can I move over to yourself? So again, just a little bit about yourself, your organization, and then summarize 2025 in one word for 26.
Yeah, sure. Thanks, Tolga. So Nick Snazel, Market Insight Strategy Director at Stark Building Materials UK. Over 20 years now in the industry, previously with Saint-Gobain and now with Stark Building Materials. And our background as Stark Building Materials is very much around builders merchanting and associated merchants, and we're exposed to a big chunk of the market, well, all of the market, but primarily we're probably 2/3 into housing, primarily more to residential repair maintenance improvement, but also strongly with new build housing as well. So our customers range from all the way across from the major house builder to major contractor to civils infrastructure companies, all the way down to the private individual as well. So we're exposed to the whole sort of construction thing, and the strength of the housing market is crucial to us as a business and as an industry. And what we saw last year is probably a very challenging year. If we look at the data available to us, which is GfK, which provide an output of all the builders merchants in the industry, pretty much most of the main players are included. It was a flat year at best. We've got data up to the end of November, and we know the industry wasn't able to pass through price, which means it's a challenging year, which means you can't pass through your own costs, you can't pass through the supply costs, which then points to that the underlying volumes are tough out there. We've seen a number of businesses cease trading in the industry. We've seen businesses have to do a lot of changes with maybe some branch closures as well. So it's been a very tough year for the industry. So that's when we did start fairly well last year with new build housing driving the data, probably up until May, June time before it started to notably have a drop off. So it was a bit of a half and half year, and then obviously the budgets really just slowed a lot of things down in the housing market. So it was tough on a number of accounts last year, and then for next year, in very quick summary, I think similar to Sarah, just cautiously optimistic, but more second half weighted.
Yeah, I think that point around the budget is an important one because we had such a long run into it that everybody was kind of on hold for 4, 5, 6 months thinking about this budget that ended up not delivering a huge amount of new news, did it? Ed, on to yourself, please. And yeah, same thing. Sentence on 2025 and one word for 26.
Yeah, no worries. Hi everybody. I'm Ed Griffiths. I'm head of analytics at Barbara ABI. So I'll just do a bit of what Barbara ABI is, I suppose. So we track planning applications, approval, and construction starts across the UK. To give the industry a clear data-led view of what's really happening and I suppose what's coming next as well. For us, for Barbara ABI, 2025 has been a year of probably realism rather than recovery. So kind of watching what's been happening in the industry and speaking to customers, really getting a feel for, I suppose, some of the pain that people have had to endure, particularly when it comes to pipelines being much more protracted. I suppose in 2025, we've probably observed that expectations have reset to match delivery. As I said, lots of clients just echoing very much what Sarah and Nick have both shared, particularly on the delays around planning applications going from approval to from application to approval and approval to on-site and even on-site to completion. If I had to sum up my outlook for 2026 in one word, I'd probably use the word selective. That's it. There you go. On brief.
Thank you very much. Selective. We might pick up on selective in the next question. So, both Sarah and Nick, you've sort of mentioned about cautious optimism. How, if at all, do you think 2026 looks different to 2025? I mean, Nick, there's a wry smile. Maybe I'll point to you.
Yeah, I mean, initially, my concern is that we may see, in terms of the house building information, because it was a strong start to the year last year. Are we going to see a year-on-year challenge in the house building data? Yes, quarter on quarter, we may see some sort of pickup, but year-on-year, there's a bit of a concern that how will it flow through?
Mm-hmm.
So slight different maybe in the shape. So it could be that last year it was more sort of first half weighted and second half became more challenging. So it could be the reverse this year, that first half is a little more challenging, but we may see as long as the government stays quiet and we know where we stand with everything. Hopefully it's just hope, but by the second half of the year, yes, consumers and business may have some confidence, but it is a hope because the challenges still remain. The challenge of cost, the challenge of running a business, the challenge of business rates. That's obviously very big in the news right now, and that's an issue for us as a business as well. We've got business rate multipliers changes and all sorts going on with our property portfolio. Rents keep going up. Anytime you've got a rent review, all your business costs keep going up, and then we've had employment costs going up. So that ability to pass through price in what is in a tight volume market continues. So some elements continue, and maybe the shape of any sort of volume movements is what changes from last year, and that's probably how I'd explain things at the moment. Yeah.
So it sounds as though the cost of business is sort of changing insofar as it's moving in that same direction that it's always been moving, but that direction is ever upwards.
Yes.
Sarah, I wonder if I could just move on to you. So previous to this, we spoke a little bit about the consumer side of things, and I suppose if the cost of business is going up, and as Nick's describing, it's difficult to pass those on, then understanding where the consumer is quite an important part. I wonder if I could just ask you to comment a little bit on how you think the consumer is set.
Yeah, the consumer market's a strange one at the moment. I've actually prepared 3 little slides, which I'd like to share, if that's
Fantastic.
okay.
Yes, please do.
So just bear with me. So I don't know if you can see that.
We can, Sarah.
Yep.
Okay, right. What you're looking at here is real household disposable income and the household savings ratio. And we're looking at it since 2007, so just after the financial crash on both charts. And you can see that after a shock, household savings ratio is relatively high, around about 10% of disposable incomes put into savings. Okay, and then as people become more confident, the savings ratio drops off.
Mm-hmm.
This huge spike is during COVID, when people had nowhere to go and nothing to do, and every spare penny was put into savings. You can see afterwards, the recovery phase after COVID, And then the invasion of Ukraine happened, and the geopolitical situation got worse. We had inflation going through the roof, and interest rates shooting up. So the household savings ratio has gone back up to where it was after the financial crash. So a lot of money is being put into savings at the minute.
Mm.
You can see disposable incomes rose pretty steadily. Then we had a period of decline just after COVID and in 2022, 23, before we saw another increase towards the end of 2024, which corresponds with a lot of increased savings. And then things have flattened off since. So we've got pretty much flat disposable income rises for the last 4 quarters, but savings still continuing at around about 10%. Okay. We can also look at the financial situation of households and major purchases. This comes from GfK. So we can see major purchases before COVID used to pretty much follow the current financial situation of households. After COVID, the two data series have split. So households are actually feeling around about the same as they were pre-COVID. So I know it's very erratic, but still we're hovering at around about, 25 basis points there. However, the major purchases index is still extremely low. It is increasing, so people are feeling less willing to spend money on major purchases. We know they're putting it into savings. And then the third chart, which is what's called housing equity withdrawal. So that comes from the Bank of England. And we can see this again looks at before the financial crash. This is going way back to 1998, back in the darkest depths of history. Before the financial crash, a lot of people used to use housing equity to fund home improvements and RMI projects. After that, after the financial crash, people actually were investing more into their housing equity, so overpaying on mortgages. And we could see that continued right up to COVID. There was a little blip after COVID when people were taking money out to improve things, and we saw that in the race for space. A lot of people did their back gardens and home improvements during that time. Since then, with interest rates being so high and inflation being high as well, a lot of people have been putting a hell of a lot of money into housing equity. So what that tells us is people do have the funds available to spend, but they are choosing to put that money into savings and into housing equity because of the lack of confidence. And that's driven by the geopolitical situation, by inflation, and by a lot of other things that make people feel anxious about the future. So when people are feeling anxious, they're more likely to spend rather than save. With interest rates starting to come down, and we do expect that to happen through next year, all being well, that situation will tend to ease, and there is a hell of a lot of money built up in savings and in housing equity that could be released to start getting the housing market and the RM&I market moving. I don't expect it would happen fast, but it could happen pretty fast as well. So it's difficult to say what's actually going to happen, but everything's in place for the consumer market to pick up, and that in itself will start driving the general economy and get things moving. What we could do with is a bit of government stimulus to help that get moving and get started.
Yeah,
Sarah,
I think
thank you. That's
yeah. Sorry, just to drop in on that as well. I think what we have seen is housing transactions have actually held up relatively well. I know we had a bit of a boom in the first quarter, driven by the stamp duty change, which led to a lot of transactions completing before that happened. But yeah, since then it's recovered reasonably well. The challenge we find as a business and probably as a wider industry is the willingness then of that house purchase to then spend money on their home as a major improvement project. Now that appears there was the link where maybe it was circa 1 in 5 homes that transacted would then go ahead with some form of home improvement project, and that seems to be dropping as a ratio, closer to, I think there's a report I found saying it's more like 1 in 6 is getting closer to. So that relationship of transaction to home improvement seems to just forced out a little bit, and that's probably causing some of the issues in the industry while we're just stagnating as an industry, despite the fact the transactions are holding up. we're just not seeing that level of, because people are taking on a higher mortgage is at higher base rate, with the base rate still coming down. We may get 2 base cuts this year. The markets are suggesting 3 maybe at the most, but the rates that people are paying on their mortgages, the house prices, yes, may have flatlined, or they may be only up 1% this year, or whatever the forecast is saying, but the level people are having to spend going out each month is picked up, and anyone that is on a mortgage has probably gone from a fixed rate of something close to a low base rate over the last few years, have moved off their 2, 3, 5 year fixes. And we're probably come to the last year or two now of that, and there's still another tranche of people to come through in 2026 who've then got to take on another
swallow a fairly bitter pill.
Yeah, and those with the higher incomes have been linked to what Sarah's just saying now, have been overpaying on their mortgage in preparation for that, rather than putting that money away to perhaps finance a major improvement project. So, but it's not all doom and gloom, because our builders aren't just sitting on our hands doing nothing. They are.
Well, I mean, that moves on to the
yes.
I guess in this sort of context of suppressed investment historically. And Sarah, you've got a viewpoint on the kind of the outside of the buildings, and Nick, you've got a viewpoint on the inside of the buildings. Is it a uniform trend, or are there any areas within or outside the house that you're seeing performing better? And I'll ask you just if you could just as concise as possible, because I'm conscious of time.
Yeah, I think what we saw after COVID again is this race for space. A lot of people did their back gardens at that time. We had a really good summer during the period just after COVID. A lot of people did the back gardens. So we found that of those people, their gardens aren't going to be done for probably another 5 years. It's actually 5 years since the end of COVID. Probably some people might argue 6. So 5, 6 years since the end of COVID, and that cycle is likely to change, moving back towards the outside from the inside. But we have seen a lot of work coming through for inside of houses, so loft conversions, kitchens, bathrooms being done. But it's likely to start switching as those back gardens become sort of a bit more shabby and people want to replace them.
So potentially boom times for the garden centres ahead.
Potentially, and it all depends on confidence and stability in the geopolitical situation as well.
Which even 13 days into 2026 is far from guaranteed. Nick, how about you? What are you seeing in terms of I suppose rooms within the house that are performing better than others?
Yeah, I mean, we don't see any great major changes. We're selling mostly core building materials, and what the builders are buying is very much determined partly by regulation. So we always see a stepped increase in slightly in the insulation levels required, etc., as building regs increase, etc. You see just dynamic changes as well. So, for example, in landscaping, you now see a move towards porcelain. It's taken a big chunk out of the traditional paving market, as that product's just enhancing its quality. So we do see shifts and changes, but nothing massive. And you do see trends in the marketplace. You may see more flat roofs with a glazed box above it, or a flat piece of glass above it, and so more sort of warm roofs as a flat roof structure, as opposed to a standard pitch. You do see these little tweaks and changes, but there's never any. And you may see consumer changes when you're selling kitchen and bathroom products, but from a core building materials, it's limited in terms of how you see any great changes in the marketplace.
Thank you. Very conscious of time, and I think as we tip into the next half-hour slot, we'll start to see people dropping off to their next meeting. So I'm conscious that we've spoken a lot about residential. Ed, can I ask you just very quickly, give us maybe a minute on anything that you're seeing outside of the residential space, and then we'll wrap up and leave everyone to their days.
Yeah, no problem. So I suppose 3/4 of construction spend's non-residential. So obviously, what are the opportunities? So I suppose it's probably where the momentum is. So infrastructure, energy, industrial, and obviously the big digital-led construction that the 4 of us were talking about before we went live with the audience, are obviously carrying the market to an extent. So I'd be talking about things like, the obvious one is data centers, although Nick made a very good point that there's a lot of applications, but maybe not a lot on site at the moment. Grid updates, obviously, to support that, but also to support the quite aged national grid that exists in the UK. Water infrastructure, not just for data centers, but obviously the general water infrastructure is quite aged as well, and there's been some quite awkward or harrowing headlines in the last 18 months about our water infrastructure and what's happening with it. Transport, again, a lot of work that's probably going to need to be happening there. And then obviously defence linked projects as well are inevitably going to rear their head in 2026, given what's already happened in the first 12 days of this year more broadly. So all of those things show strong medium-term pipelines. We're also seeing sustained demand in retrofit, refurbishment and compliance-driven work, especially linked to energy efficiency and safety regulation. I suppose bringing it to a kind of trying to round it off for you, Toga, the opportunity isn't about chasing the broad recovery. It's probably just about aligning with the sectors that are structurally funded and politically supported. So the ones that I just alluded to, I suppose. It's worth remembering, though, and I think I can't recall if it was Sarah or Nick said this earlier, but infrastructure projects do typically span much longer periods. So 2026 is probably going to be much like 2025 for many people because a lot of the infrastructure projects that are coming will probably kick off towards the mid to end of this year and span well into 2027.
I'd support a lot of what you've just said there on the infrastructure side. We've seen our pipes business, the civils and drainage business, has been performing really well in 2025, and we are expecting that to continue through 2026, especially with the Ampere starting to ramp up now as well.
Fantastic. All right. We'll call it a day there. As we are over time, I think probably again indicative of the market as a whole. We probably could have sat here and nattered on for another hour or two, but I'll spare everybody that. We had over 200 people join today, so a huge thank you to everyone for logging on. A particular thank you to Sarah, Nick, and Ed for sharing their insights and experiences in the marketplace, and as well to Ellie within Barber ABI, who's helped to set this up and talked me through a very shaky start to actually setting up the webinar. So big thanks to everyone involved, and we hope you found it interesting. We hope you found it informative. And if you want to hear any more about the forecast bulletin or anything else, just reach out to your contacts, or as I said before, reach out to myself.